We will start off the accounting procedure for eliminating the investment in subsidiary account. Assume the following example. Company A owns all the shares in Company B. I want you to see things this way. Company A has its own financial statements, and under the non-current asset section, you will see a subsidiary line item, which represents the amount it has invested in Company B. FRS 110 requires Company A to prepare its consolidated financial statements. What this essentially means is, instead of just showing this subsidiary line item, can you show me in detail what you own and owe through this subsidiary? Remember, if Company A owns Company B, it literally owns all assets and assumes all liabilities of Company B. So FRS 110 wants Company A to show how much assets and liabilities Company B owns and assumes, which actually belongs to Company A as well, since it is the holding company. Therefore, we want to expand this investment in subsidiary line item to show what Company A owns through Company B. The subsidiary line item represent the assets and liabilities of Company B as shown. So the group total will consist of the assets Company A and B owns and the liabilities Company A and B owns, instead of just an investment in subsidiary line item. Now the problem is, by default, the consolidation worksheet will add line by line all figures in Company A and Company B. We don't want the investment in subsidiary to appear in the group total, since we have expanded it to show the assets and liabilities of Company B. We also don't want to add the equity component of Company B. We are only interested to add its assets and liabilities. To prevent the consolidation worksheet from adding the investment account of the holding company and the equity account of the subsidiary company, we will enter the following consolidation journal entry: debit share capital, debit reserves, debit retained earnings, and credit subsidiary. This is called eliminating the investment in subsidiary account, but I hope you understand the logic behind this. The reason for entering this journal entry is to achieve the effect of expanding the investment in subsidiary account to show the assets and liabilities of the subsidiary company instead of just showing the investment in subsidiary line item. Often, the amount an investor invested in the investee is different from the investee's net asset at fair value. The earlier example assumes they are the same for the purpose of simplicity. So what if the cost of investment is different from the fair value of net assets acquired? This will arise in goodwill. Goodwill is an intangible asset that is not separately identifiable and recognized. The reason why an investor is willing to pay more than the fair value of net assets acquired is because of some potential intangible economic benefits that exist in the subsidiary company. It may be because of brand name, customer relationship, intellectual property rights, and other benefits. Goodwill can be both positive and negative. We will see how to account for each case. In this case, we noted that the cost of investment is $1,247,000 based on the subsidiary line item. For the purpose of simplicity, we will assume Company A owns all the shares in Company B. The consolidation journal entry to eliminate the subsidiary account is debit share capital, debit reserves, debit retained earnings, and credit subsidiary. Now you will notice a problem here. The total debits does not equal total credits. The fair value of net assets acquired is $1,019,000, referring to the total equity figure in the subsidiary's financial statement. The $1,247,000 cost of investment exceeded the fair value of net assets acquired. The difference is what we call goodwill. So we will insert a plug figure, goodwill, to force the debits and credits to be equal. By debiting goodwill, we are recognizing an asset, which represents the premium paid to acquire the subsidiary. Goodwill is not subjected to amortization and is assumed to have an indefinite useful life. However, the holding company should assess each year if goodwill is impaired. If the holding company assesses that goodwill is impaired for the current year, the consolidation journal entry is debit impairment loss on goodwill and credit accumulated impairment. To record impairment of goodwill in previous year, the consolidation journal entry is debit retained earnings and credit accumulated impairment. Please remember again that the holding company will not maintain a good accounting system. Instead, it performs the consolidation process from the very beginning every year. Hence, you need to record the same consolidation journal entry again each year. However, we debit retained earnings instead of impairment loss on goodwill for previous year impairments, because if we debit impairment loss on goodwill, we will be recognizing the previous year's loss into the current year's loss, overstating the current year's loss. So we will debit retained earnings instead, because logically, a previous year loss will go into the retained earnings account. To illustrate how this consolidation journal entry works, let's assume that in year 2, goodwill is impaired by $28,000, and in year 3, goodwill is impaired by another $100,000. What is the consolidation journal entry for year 2 and year 3? The consolidation journal entry for year 2 is debit impairment loss on goodwill and credit accumulated impairment by $28,000. Moving on to year 3, the consolidation journal entry is debit retained earnings by $28,000, debit impairment loss on goodwill by $100,000, and credit accumulated impairment by $128,000. The debit retained earnings recognizes the impairment of goodwill in year 2, and the debit impairment loss on goodwill recognizes the impairment of goodwill in the current year. Remember that we debit retained earnings to record previous year impairment. We do not debit impairment loss on goodwill by $128,000 in year 3 because we will recognize a loss of $128,000 when the loss is just $100,000 in year 3. Therefore, the previous year impairment is debited through retained earnings so that the amount of loss recognized for the current year is just $100,000, which is the current year impairment. Now let's consider another example, where the subsidiary line item indicates a cost of investment of $1,245,000. Again, let's assume Company A owns all the shares in Company B. The consolidation journal entry to eliminate the investment in subsidiary account is debit share capital, debit reserves, debit retained earnings, and credit subsidiary. Again, we realize the total debits does not equal total credits. This time, the cost of investment is less than the fair value of net assets acquired. The fair value of net assets acquired is $1,247,000, as seen from the subsidiary's total equity line. If the cost of investment is less than the fair value of net assets acquired, we deem it a bargain purchase, which is recognized as an income, and it represents that the holding company managed to acquire the subsidiary at a discount. We will insert the plug figure bargain purchase into the journal entry to force the total debit to be equal to the total credit. Please note, however, that this consolidation journal entry is only for the year of acquisition. Subsequent to the year of acquisition, the journal entry is debit share capital, debit reserves, debit retained earnings, credit retained earnings, and credit subsidiary. We will credit retained earnings instead of bargain purchase because we don't want to recognize the income again for each year. The income should only be recognized in the year of acquisition. Anyway, the income will also go into the retained earnings at the end of the first year, so we will credit retained earnings instead.